Hi all, once again. Let's understand the changes that are being brought in this Finance Bill 2024 on buyback taxation. Uh, Under Section 222, dividends are defined to include clauses A, B, C, D, E, which is colloquially or loosely termed as deemed dividends. A new clause under clause F is being brought in effective from 1st of October 2024, wherein any distribution by a company arising out of a buyback scheme to the shareholders will be taxed as a deemed dividend. Now there is already a section called 46A under capital gains, wherein any distribution arising out of a buyback will be taxed in the hands of the shareholders at a flat rate of 20% without any indexation, for the simple reason that is a code by itself. Now the issue in that section is that it is going to be taxed on a flat rate basis, while the problem that has been plaguing the buyback taxation in the Indian securities environment is that with the flat rate of tax, promoters or promoters have been laughing their way all the way to the banks. To plug this is why this is being brought in the form of a deemed dividend. Okay, now by calling it as deemed dividend, this is going to be taxed at the respective slab rates, wherein most of these promoters are going to be in the highest tax bracket invariably. This is on one side of the story. The other side of the story is there was a 115 QA as well, wherein the company used to pay the buyback tax again on a flat basis. This section will no longer be in vogue, and there is a consequential amendment both under 46A as well as in Q under 115 QA, wherein 115 QA will no longer be valid effective from 1st of October 2024, and 46A has a consequential amendment telling that what is taxed under 222F cannot be brought once again to tax under 46A. Now let's step aside for a couple of minutes and understand some fine prints behind this. A buyback is also one form of capital reduction, because under the Companies Act, Section 68 talks about buyback, wherein the bought back shares will need to be cancelled within 7 days as per the Companies Act 2013. Now, how does the taxation happen in the case of a normal distribution of capital in the event of a capital reduction? There is a section called 222D, wherein up to the accumulated reserves, whatever is distributed by way of capital reduction is treated as a dividend, and it is only the excess amount beyond that can be brought under capital gains taxation. The logic is quite simple. What is invisibly distributed in the form of a dividend will need to be called as a dividend, irrespective of the texture or the form how it goes back to the shareholder. This is one side of the story. We recently had the landmark case of cognizant decision at the Chennai tribunal, wherein a buyback of shares at a cross-border on the cross-border arena was recharacterized or read as dividend, and the tribunal went giving the verdict in favor of the revenue. The drafters of the finance bill perhaps have taken a cue from that, wherein one of the plea which was took in that which was impressed upon by the SSC in that particular IDAD decision was that 232 subsection 10 explicitly makes a mention telling that buyback will necessarily need to be done only under section 68 of the Companies Act of India. So the reference to section 77A of the old Companies Act 1956 is also being kissed goodbye by virtue of an amendment in the finance bill. So much on buyback taxation. Now if we see the principle behind buyback in the corporate ethos, basically when a company is unable to distribute or is unable to find avenues to is unable to find adequate avenues to invest profitably, it makes sense to distribute all those accumulated profits as a dividend. This is the idea behind a dividend. When a company is not able to do investment adequate to the shareholder expectation, it is sensible for the company to return back whatever it has accumulated in the form of a buyback. After all, buyback is also one form of capital reduction. So what dovetails capital reduction taxation will also be dovetailing buyback taxation as well. For example, one of the issues in capital reduction taxation is when there is no consideration which is given to the shareholders, what happens to the cost of the bought back shares. This has been an intriguing issue wherein in a recent Tata Sons decision, it was held irrespective of whether there is a consideration or no consideration, the same will be treated as a short term or a long term capital loss depending upon the period of holding, and it will be available as set off against other types of capital gains as the categorization according to the principles of capital gains carry forward and set off losses, or alternatively it will be carried forward for 8 years for future set offs. The same dovetailing principle will necessarily need to be done even for the cost of bought back shares under no matter the distribution of the amounts in a buyback. The reason I am saying this is there is no linkage between section 222F nor under 46A nor under any other section explicitly which is being proposed in the finance bill, which will entail the person who has shelled out the money for purchasing the share to adjust it against the dividend income or to set it off against in any other manner in relation directly to the bought back. So bought back shares and the consideration will be taxed like a separate silo. White Finance Bill 2024. The cost of the bought back shares will need to be adjusted and carried forward and set off